This week, Wall Street's risk pricing models underwent a historical stress test. A geopolitical relief rally triggered by a Middle East ceasefire was immediately met by a wave of selling as the Federal Reserve dismantled its communication framework. In response to this sudden policy vacuum, institutional capital is aggressively abandoning traditional diversification. Billions are now funneling into a narrow cluster of tech monopolies with absolute pricing power. This terminal UI shows the resulting divergence across the major indices. The Dow Jones edged up 0.71%, and the S&P 500 gained 0.93%, but the Nasdaq Composite broke away with a 2.43% surge, while the Russell 2000 rose 1.22%. Volatility and defensive assets contracted simultaneously. The VIX fell 7.24% to 16.40, even as the US dollar index climbed to 100.81 and the yen maintained its strength. The commodity board shows a much more aggressive retreat. WTI crude dropped 6.53%, Brent fell 4.64%, and gold lost nearly $130 an ounce, while Bitcoin bled down to the $62,000 level. This simultaneous exit from gold, oil, and crypto indicates a pivot in institutional strategy. In a high-uncertainty macro environment, traditional hedges are being traded for companies with guaranteed revenue streams. This shift is creating a concentrated AI safe haven rotation. Smart money is concentrating its liquidity into the few firms that control the core infrastructure of the next decade. Just look at NVIDIA's corporate bond issuance. A planned $20 billion raise was met with $85 billion in institutional demand. This massive oversubscription forced the company to upsize the offering to $25 billion. Simultaneously, SpaceX hit the public markets with an immediate valuation of $2.4 trillion. SpaceX utilized this capital advantage immediately, executing a $60 billion all-stock acquisition of the AI startup Cursor. This flight to tech generated extreme trading volumes. Micron saw $72 billion in daily volume, and Marvell surged 15% as institutions rushed to secure positions. This emerging trend is severely punishing anything outside the tech core. Group Dynamite reported growth in both profit and revenue, yet the stock crashed 36% because its forward guidance failed to meet Wall Street's heightened expectations. Institutional capital is rotating out of traditional, rate-sensitive industries to feed these tech giants and their massive multi-year capital expenditure pipelines. The week's volatility was driven by two distinct macro factors, beginning with a temporary geopolitical shift in the Middle East. In France, the US and Iran signed a memorandum of understanding that reopened the Strait of Hormuz. This immediately removed the war premium from the energy markets and caused the flash crash in oil prices. While lower energy costs provide a valuation buffer for tech stocks, the risk remains fragile. Political hardliners in Washington have already begun challenging the agreement, leaving no room for diplomatic error. The 10-year Treasury yield held firm near 4.45. Early in the week, the Iran agreement lowered commodity prices, allowing tech stocks to capture nearly all the available market liquidity. The shift occurred on Wednesday. The Federal Reserve kept interest rates at 3.5 to 3.75%, but the policy statement itself triggered a wave of selling. The new Fed chair, Kevin Warsh, announced the formal end of forward guidance. After 14 years of the Fed managing market expectations, policy is now moving into a purely data-dependent black box. Without a clear roadmap from the Fed, automated selling algorithms reacted instantly. The sudden lack of central bank transparency sparked a broad retreat from equity markets. The pressure increased when the Fed's dot plot showed that 9 out of 19 officials still expect another rate hike this year. This led to a rapid 800-point reversal in the Dow Jones. Thursday saw a sharp reversal. NVIDIA CEO Jensen Huang delivered a keynote in Texas, characterizing AI infrastructure demand as entering a hot summer phase. This industry-level certainty triggered a massive short squeeze. Micron, Marvell, and Intel surged, and the 3 times leveraged SOXL ETF gained over 19% in a single session. Without the Fed's safety net, macroeconomic data has become a source of volatility. Market participants are now using industry-specific microdata as their primary pricing anchor. Next week, the market will face 3 specific tests: new PCE inflation data, political friction surrounding the Iran MOU, and the quarterly rebalancing of institutional portfolios. This chart maps the 3 scenarios for the Dow Jones. A bull case targets 52,200 on cooling inflation data. The base case suggests a range between 51,000 and 51,800. A bear case at 50,400 becomes the target if oil prices see a 4% rebound. This is the S&P 500 projection. A bull break over 7,580 is possible if rebalancing creates a tailwind. The base case sits at 7,420 to 7,530. However, if the VIX crosses the 20 level, technical selling will likely push the index towards 7,310. On the Nasdaq, continued AI momentum could push toward 27,100. Our base case is 25,900 to 26,700. The bear case at 25,300 is triggered if the 10-year Treasury yield breaks above 4.55%, which would force a re-rating of tech growth multiples. These precise technical levels show that the market has moved into a highly defensive, boundary-driven environment. With the risk-free rate holding near 4.45%, institutional strategies are focused on companies that control the physical bottlenecks of AI development. This NVIDIA chart highlights an entry zone between $206 and $210.69 at the 50-day moving average. We have a hard stop loss at $189.90. The $245 target reflects margin expansion from large-scale B200 chip deliveries. This is the setup for Micron. Avoid chasing the surge. Instead, wait for a technical pullback into the $1,050 to $1,080 entry range. The stop loss is set at $950. Based on HBM memory capacity control, our upside target is $1,300. For Marvell technology, the entry range is $302 to $310.58. We are using a stop loss at $281 and a price target of $385, reflecting its dominance in optical networking. In an environment of extreme macro uncertainty, these hardware bottlenecks offer a structural layer of protection. Like, subscribe, and share Calling Monster Finance for more deep dive US stock analysis.